Welcome to the Pavilion Flow-Through Fund by Accilent Capital Management. The Flow-Through Shares program provides for over 100% tax benefit to participants for every dollar purchased of Canadian resource company flow-through shares. This major tax incentive exists to help alternative energy, mining, or oil and gas companies use the money to explore for and develop new resources, in turn helping promote remote communities and employ thousands of people. A flow-through share is simply a special type of common share sold by a Canadian resource company to help it raise capital for exploration. However, it is quite common for these companies, especially the smaller ones, to have no net income for tax purposes, so they fund themselves with no need for the tax deductions related to their exploration expenses. The federal flow-through share program allows the companies to transfer these expenses directly back to the investor. Purchasers of flow-through shares can then deduct the expenses against their own personal or corporate income taxes. The main deduction in the program comes in the form of a Canadian Exploration Expenses, or CEE, credit, which effectively reduces the investor's taxable income by 100% of the amount invested. A more recent addition to the program, the Mineral Exploration Tax Credit, or METC, comes in the form of a federal 15% investment tax credit. The combined CEE and METC credits equal a 115% deduction of taxable income. One of the top performing flow-through funds has been the Pavilion Resource Fund Limited Partnership, offered by Accilent Capital Management. Accilent Capital is a boutique investment firm located in Toronto that specializes in alternative assets, commodities, and discretionary portfolio management. Accilent Capital has designed a number of private equity funds over the years, but the longest running offering has been the Pavilion Fund. Pavilion has already helped close to 1,000 high-income earners lower their taxes while at the same time diversifying their portfolios into Canadian natural resources. Pavilion has consistently been, by net asset values, one of the top performing flow-through funds in Canada, even during some of the most volatile markets in recent memory. We'll now look at the full life cycle of a Pavilion investment to see how the process works for an investor. First, investors purchase units in that year's Pavilion Resource Fund Limited Partnership at a minimum of $10,000. The fund manager uses this capital to purchase the flow-through shares from as many as 20 or more Canadian resource companies in order to build a diversified portfolio. The following April, each investor receives a T5013 tax slip outlining the number of units purchased and the corresponding tax credits. All investors will receive a T5013 each year that the fund is in operation, and there will be additional small deductions available on a continuing basis. Almost all other flow-through funds in Canada have short 12 to 24-month terms, which does not give the resource companies they purchase much time to try and realize results on their drilling activities. Pavilion funds are specifically designed as longer-term flow-throughs for two very important reasons. The longer time frame allows the resource companies more time to work through the cycles needed in their exploration activities, and two, to allow breathing room if the junior resources market goes through a longer, bearish period. Typically, Pavilion funds will operate for a period of 36 to 64 months, although it may be shorter depending on market conditions. Additionally, this does not mean that investors will necessarily wait for up to 64 months to see any return on their invested capital. As the fund is fully managed on a day-to-day basis, there are times when the portfolio manager may sell some shares in order to take advantage of price increases and as a method of risk mitigation. At any time that enough shares are sold to make a meaningful cash distribution, the fund will do so. Our history shows that some cash tends to be returned on all funds almost every year throughout their lifespan. Then, at the appropriate time, the fund manager will liquidate all remaining shares and wind up the fund, sending investors their final cash distribution. It is very important to note that all monies received by the investor at any time are taxable as a capital gain, in which 1/2 of the returns are taxed. The reason every dollar sent back is taxed is due to the fact that there is 100% tax relief upfront to the investor. So CRA deems the original value of the purchase to be zero, so capital gains needs to be paid on all returns. However, this tax treatment is very beneficial, as it means you are effectively converting income today at your highest marginal tax rate into a future capital gain. As an example, we've got Bob, who lives in Ontario. The numbers in this example are only rough approximations, but close enough for illustrative purposes. The assumptions we will use: Bob earned $250,000 this year. He is in a top marginal tax rate of 50%. He invests $10,000 into Pavilion. The value of the fund on maturity is exactly the same as when purchased. Bob's marginal tax rate when monies are returned has not changed. If Bob had not invested the $10,000, it would be taxed at a rate of 50%, which equals $5,000. If he does invest the $10,000, this amount will be deducted from his income as a Canadian exploration expense, as if it was never earned, and he will not pay tax on it. Once the mineral exploration tax credit of 15% is taken into account, Bob will reduce his taxes by another $1,500 for a total of $6,500. In reality, the total credits will be reduced somewhat in the first year due to the expenses of the fund. However, these expenses will be amortized and recovered over the life of the fund and reported on Bob's T5013 slips each year, giving him small additional yearly deductions. Typically, there's about 100% in tax incentives realized in the year of purchase and the remaining in the following years. As mentioned previously, all amounts received by Bob over the life of the investment will be taxed as a capital gain in the year received, due to the adjusted cost base being zero. As the fund breaks even in this example, Bob would receive the original amount invested, $10,000, returned over the life of the fund, and half of that would be taxed at 50%, giving him a $2,500 tax liability. But remember that he received around $6,500 in total tax benefits, so even though the investment did not go up in value, Bob is still ahead by about $4,000 on his $10,000 investment. This equates to a 40% return on investment. Additionally, if Bob had some unused capital loss carryforwards available, he could now use them to offset some or all of the capital gain being taxed. One potential use of Pavilion is what's called laddering, which involves purchasing some Pavilion LP units yearly for 4 or 5 years as a program, providing a yearly stream of tax savings and cash proceeds from distributions of the funds to offset future purchases. In our example, Bob purchased $10,000 of flow-through and received approximately $6,500 in tax incentives. If he did the same in year 2, the result would be similar. In year 3, however, the new investment could now be fully funded by past tax savings. A second method of utilizing flow-through is to help delay a large one-time lump sum tax from any source. In this case, Bob has owned a small commercial building for many years and is thinking of selling it. This will leave him with a substantial capital gains tax payable. A one-time, larger purchase of flow-through can help push the gain to a point in time where we may have a lower tax rate in addition to the tax savings already available. To summarize, flow-through is the only significant tax shelter available today, and it's a smart vehicle for high-income earners and those who realize a large taxable lump sum from any source. Accilent Capital has successfully launched and managed Pavilion flow-through funds annually since 2008, with many of these funds being best performing in the field. The current fund is now available for sale, but will be closed for new investment in mid-December of this year, so you're encouraged to speak with your advisor. For more information or to reach out, please visit pavilionfund.com.